We create a secondary market for limited partnership interests in private equity funds. And what that means is if you're an investor in Blackstone, which traditionally private equity funds have 10-year lives, and they are illiquid vehicles, like on and off a little, you have no way of really getting out of those vehicles. We create basically a liquid market for that. So we will go to an institution that has an investment in a fund like Blackstone who wants liquidity for one reason or another and buy out their limited partnership interest. And then we'll hold on to it for the rest of the term of that partnership. So the type of analysis that we do is we look at the underlying portfolio companies within those funds, analyze those companies, and value them and decide what we're willing to pay and buy those assets at some discount to what they're valued at. So my business is less about trends, more about valuing companies. And the issue that we have is, if anything, too much data. You know, the amount of data that you can get now is so different than when I started in the business 20 years ago, where you had very little data available. Now, you know, the internet has created this ability to get, you know, volumes of data on all types of companies. Now, most of these companies are private, so it's not like we're buying into public companies, so it's somewhat contained. But the issues for us are more about our judgment about the data and how we sort of, in a very short period of time, can evaluate these companies and make a decision about what we'd be willing to pay for it. Obviously, it's a competitive market, so pricing is important, and we need to also assess the risks. And as Mary said, everything has its risks. Every investment that you make has risks, and you just have to determine, you have to understand the risks, and then you have to understand what the trade-offs are and what risks you're willing to take. So our investors in our funds understand that there are risks involved, but they also understand that, you know, you get a certain amount of return to take some amount of risk. When we think about sort of the data side of the equation, it's much more about us over the course of a week having to evaluate, you know, hundreds of companies, basically value them, value a portfolio, you know, model lots of companies, lots of funds, roll it up into a big model, do a lot of analysis, and sort of have the judgment to make assumptions about sort of how we think about company growth over periods of time, how we think markets will do over periods of time. Most of it is US, but we do look globally. So, I mean, there's some judgment involved in what we're thinking about, you know, what's happening in other markets. However, it's much more about how we take the data, synthesize it, and come up with something that makes sense from a judgment standpoint, where we price it and hopefully can sort of buy it. So I think, you know, today's world is about just too much information almost, and being able to figure out how to kind of cull it and decide what's important.